Good morning and welcome to the Saxo Bank Morning Call. It is Tuesday, April 9th, 2019. And just to start off at the top of the program, let's go to our slide here. We have a webinar up later today. Mr. Kim Kramer Larson will be presenting a technical view of the market. He'll be going over equities and a number of instruments. So for a more technical look of what's going on, please tune into that webinar. You can sign up at webinars.saxo. So back to the markets. We had another not terribly exciting session yesterday, but the market I'm really focusing on, of course, we're all looking at these all-time highs in U.S. equities. The major S&P 500 benchmark, we're some 1 or 2% now from the all-time highs there. But also the bond market. Looked at this same chart yesterday. Just for perspective, I think it's really interesting to see what happens to the U.S. yield curve as we're back at very interesting levels. So look at a chart here. I've got the 2-year and the 10-year on the left. You're seeing the 2-year rate back up at 2.35%, essentially the current Fed funds rate. So you could argue we've largely priced out most of the anticipation of the Fed actually switching into a rate cutting mode. And you see also that inflection point near the prior lows in yield at the very beginning of the year. Similar for the 10-year on the right, around that 2.5% level. I think these big round yield levels are very important there. So to me, if we were able to go further higher in yields, this really does encourage this so-called sort of 1998 melt-up scenario. If markets are able to get over the hurdle of the U.S. yields heading higher and still gobble up risk. On the flip side, if we're seeing yields coming back lower, it suggests that really there's not enough underlying risk appetite to continue to drive risky instruments higher. At least on the economic front, though, where I think there's some little signs of encouragement here and there. Peter, you've pulled up the global leading indicators suggesting some stabilization.
Exactly. We had the new numbers out from the OECD on the global economy, and as you can see here on the chart, I've zoomed in on 3 countries. So there's the global, which is the blue line. South Korea, which is the most leading country in the world, is the orange one, and then the green one is China. As you can see here, China the weakest. Global leading indicators still declining, but the speed of the declines are diminishing by every month now. So my personal belief is that the probability for a turning point is increasing by every month now, and South Korea seems to be turning. There were some revisions to the later months data. I have previously said that South Korea looked like they turned already back in December or January, but now it seems like that has been postponed, and it seems more likely now that they are turning around in February. So I think there are potentially green shoots here, but there's a lot of uncertainty still. I don't think this is clear signs in any way. But it's just an anchor that can guide our expectations. So I would not be surprised to see the global economy
at least some kind of stabilization, if not necessarily a raging return of growth. Of course, we're all waiting for this U.S.-China trade deal. I've got a chart here of just to show with perspective on volatility of dollar CNH, so the dollar renminbi, and you can see this is a implied and realized volatility. The implied volatility in green, getting towards the local lows here around 4%, and the actual realized volatility likewise at local lows. Nobody's anticipating, or not nobody, but very few are anticipating a massive move in the currency, and we're all waiting. And it looks like the latest news is that we could be waiting 4 weeks or more for whatever this deal looks like. And so many different people trying to apply spin on what the quality of the trade deal would be. Of course, the Trump administration is saying it's going to be great stuff. But other sources, there was one I retweeted this morning indicating there may be some concerns from the U.S. side on progress. We don't know where this is headed. I think the anticipation level, though, is quite low on this front. But I do think it is. Look at that low volatility, and I think it is what we're suggesting that this is pointing to one of the things that is creating such low volatility across the foreign exchange space. And I'll have some more on that later. But Peter, I wanted to pull up this story on Sony. I think it's one of the few cases where we've seen a really big jolt in markets. A specific stock story that's quite interesting. Yeah,
it's this bellwether of technology in Japan, and the shares are up 9%. And what we have here is Third Point Capital, which is run by Dan Loeb, one of the more famous hedge fund managers. Pretty good track record at Third Point. They have a large part of their portfolio being allocated to activist endeavors, and now they're zooming in on Sony. They want to do major changes. They have board seats, and as you can see here, the share price is responding very positively to the news. It has been in full decline since October. It has not really gathered much speed this year, despite the global equity market being up 15%. I've just pulled in some valuation metrics for you here. So the EV to EBITDA is around 5 times. So that is a 60% discount to global equities. Also, the free cash flow in the previous fiscal year was $1.2 billion versus a market valuation of around 6 or 7. So it's I would arguably say it looks very cheap.
Interesting to see something of deep value. And these days we're talking about complacency and all-time highs, and you can still find these deep value stories if there is deep value there.
Yeah, and you have a catalyst here that I think that makes this case interesting. So that might be some opportunities for you out there if you're a trader or investor.
And then we have the Lyft IPO, not getting off to a glorious start, but we've got another IPO up. Is it today or is it soon? Next week?
It's next week. It's Pinterest. This I think it's very. Some people say it's a misunderstood company. I don't know really what it is. We talked about it this morning, John. It's online pinboard.
Somebody told me it's for women, but I'm not a big knowledgeable person on this front.
I don't have a user profile on it either. But it's an IPO. It's pricing on Wednesday. They're offering almost $1.3 billion to the public. First day of trading is expected on Thursday. It's pretty sizable. As you can see here, the news from Financial Times, $11.3 billion of valuation. They're still not profitable. I think that's seems to be the case nowadays when you are apparently doing an IPO from a Silicon Valley VC firm. But that's how it is. I'll do a preview on Pinterest, whether this valuation makes sense and what are the prospects for the company.
Yeah. Now, we talked a little bit about global growth potentially stabilizing, certainly hopes out of China that the stimulus there will lead to faster growth. And we've seen iron ore futures up to new local highs, and we're seeing the Aussie trying to get something going. It certainly has been able to do so versus the Kiwi. I think the relative story there, one of the very few trends we've seen in currency markets. I have a chart here of the Aussie versus the dollar. We can see we're still bogged down in the range. You know, we've been triangulating for quite some time now. This is a range we first reached back in September of last year. You essentially have been trendless in Aussie dollar over the last 6 to 7 months. But locally here, getting to interesting levels, 20, 25 plus day breakout if we're able to close above current levels around 71.50. Been a lot of false breaks in markets recently. Interesting to see if something can get going on the currency side of things in what has been a very low vol environment. The next slide here is showing exactly how low we're getting. This is note the timeline. We're going all the way back to 2005 here. We're talking about euro dollar and dollar yen. This is 3-month implied volatility. So how much the market anticipates moves in these currencies going forward. Getting close to those all-time lows from 2014, which were barely exceeded the lows of 2007. So historical stuff. If you recall back to those two events, these very, very low volatility spikes, and that's kind of the interesting thing to me. That back then it was a very, very steady long slide into these sort of spike lows, and then the market really whipped around and saw some very high volatility. This time we've just been in sort of a low volatility funk for quite some time. So I'm not sure. I'm super hopeful that we're about to jolt higher in volatility, but I would argue the historical lesson is that one should at least have some risk allocated to being long-term volatility. 1 year dollar yen puts calls, euro dollar puts calls around the assumption that the market is going to one day move again. But
also you have the fact that when you have a market structure like this, it pulls in a lot of money. That just selling volatility, as we have seen multiple times in equities, has probably been the best trade since 2009. And I think in terms of positioning, it means that a lot of traders are building up massive position on the wrong side. So when you get whenever we get a catalyst, then there is so much positioning that needs to be unwind and changed that you get these big jolts in the market. That's
the classic. Yeah, that's the classic setup. That the complacency encourages people to take on even larger short vol risks to get some alpha, to get some return on their capital, and then of course, yes, when the move does unfold, it's aggravated by the derivative positioning in the market. Yeah. Okay, let's get to the not terribly exciting calendar for today. We have this latest NFIB small business poll. A bit interesting to note, recent months we've seen the lowest levels since Trump became president. I'm not sure how great a leading indicator it is, but it's rather interesting on that account. Mexican CPI, a couple of Fed speakers out. It doesn't look like major policy speeches from these two who are both voters. Tomorrow's the big day really for this week. We have the ECB meeting, not expecting a lot there. The CPI, that could be quite interesting for U.S. Treasuries and the U.S. dollar. FOMC minutes, after all, this was that most recent March meeting was very dovish from the Fed. Maybe some signs there on the internal debate about how hot they're willing to let inflation run, whether they're considering more actively considering rate cuts, etc. And then, of course, the Brexit summit tomorrow, where we're going to hopefully get some kind of development pointing to a long delay. That is the scenario we're looking for. It looks like the EU wants to allow some sort of flexible delay that stretches 9 months to a year. And then the question is this sterling positive? I'm not so sure it is, because it pushes out uncertainty and could lead to a second referendum, which could lead to a no-deal exit. Certainly doesn't look like we're going to get one this week. Interesting to see if how much that fear is still priced in the market. I suspect the market, looking at volatilities, has very little residual fear that we see this cliff edge Brexit this week, rather than seeing it as a bigger risk potentially down the road, because we are still seeing long-term elevated sterling volatility despite that overall very low vol picture. That'll do it for today, and we'll be back tomorrow with Sax Bank Morning Call. Thanks for joining.